My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. If you want to make friends, I'm trying to save you some money. My job is not just to entertain you, but to educate, to teach, to discover, to learn. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. For over a decade, tech stocks led the market, and we got so used to it that we forgot this group has often been a pariah. Yet that's exactly what tech's become over the past year. So it's time to face a few facts that nobody in Silicon Valley seems to want to acknowledge. Facts that explain why the NASDAQ keeps underperforming the other averages. Like today, where the Dow inched up 2 points, S&P dipped 0.74%, and the NASDAQ tumbled 2.04%. As the guy who created the term FAANG and then made it FAANG, which now stands for Meta Platforms, Amazon, Apple, Netflix, Alphabet, and hey, why not throw in Microsoft for good measure? I know why these companies used to be the crown kings of the stock market. They had little competition, great growth, and no real economic sensitivity. But that's no longer the case. Hence, the tech's reached aside over the past 11 months. While there are moments when they can have a resurgence, Apple might report something good tomorrow. This formerly gigantic cohort is no longer what it used to be, which makes the market capitalization here very difficult to justify, even after these declines. Now, their fall-off has been well chronicled, but it took the last 24 hours to rip the shroud off of the glory of the acronym. So let's take them down one by one with an idea towards what really has happened here, because it's rather monumental. First, the FAANG names are no longer secular growth stories. Many of them have no growth whatsoever. They're now well hostage to the broader economy or even to their own, let's say, incompetence. Last night, Google told a story of advertising that didn't sound too different from what you might hear from, say, an old-school television company, linear TV. They were hurt by a lack of ads, especially from crypto and mortgage lenders. Yeah, I thought those would be small potatoes versus the ad revenue they'd be getting from anything connected to travel. Forget about it. The disappointing YouTube ad numbers should only get worse as the Fed tightens. In the end, it's a cyclical business that rises and falls with the rest of the economy. No longer is such a low price earnings multiple. We just heard something very similar from Meta Platforms. That's the artist formerly known as Facebook today. Not only did they report mixed results with better than expected sales, but also a huge shortfall here. You know what? These guys may be delusional. They just may be delusional. The forecast for the current quarter was lackluster. Why? The average price per ad is way down, off 18%. Didn't help that CEO Mark Zuckerberg warned of steep losses in the metaverse division next year, something it's proving to be a real money pit. Hence why the stock's plummeting. No, I shouldn't say plummeting. Hence why the stock is destroying everyone who owns it tonight. What a nightmare, just a hurricane of pain. And you know what? We've owned it forever for the Travel Trust. They could make anyone, even someone who's up big on it, a chump. Delusional. Microsoft had plenty of growth from the remote work environment, but that growth vanished because it's not like you need to buy a new PC every year, although people seem to think you had to. The gaming division seemed lackluster. Again, that was something that you did during COVID. Worst of all was the prediction of a slowdown in Azure, their cloud infrastructure business that had been so strong. I know Microsoft's actual quarter was excellent. They'll tell you that from now till the cows come home. But the forecast from CFO Amy Hood was ugly. And she is not, by the way, in the habit of sandbagging us with lowball guidance. So point number two, the endless claims that we're still in the early innings of cloud adoption can now be debunked. You don't get that kind of slowdown in Azure if the cloud's roaring. To put it in baseball terms, I think the cloud's now probably in the fifth or sixth inning, and there are way too many competitors. I mean, there are some like ServiceNow, reported a good number tonight, but they're few and far between. Now, Google's spending a fortune to poach customers, their cloud division, from Amazon and Microsoft. Then they're going to do something just to destroy everybody's profitability. If you're just now hopping on the cloud bandwagon, you're real late to the game. And I'm sick of hearing otherwise, although they will tell you it, because the denial out in Silicon Valley is palpable. Remember, I did not say lie. I did not say fraud. I said denial. Third, there is now so much competition with these companies. The Chinese video platform TikTok is crushing YouTube, just like it's laying waste Facebook. I was taken aback by how much damage TikTok did to Google. This is one of the greatest disruptors of all time, this TikTok. Yet the CEOs of the big dogs seem totally oblivious or in denial about TikTok's power. Maybe they're arrogant. Now, here's something you usually apply to people who went to Stanford Business School and Stanford Computing and Engineering. Maybe they're idiots. Idiots. Fourth, speaking of arrogance, these companies, with the exception, I think, of Apple, have no idea how to read the room. When you disappoint like Alphabet or Microsoft, you have to put it right up front. You don't obscure the shortfall. You don't tell us what a great quarter you had. Oh, by the way, and you never say you're going to hire 12,000 people within a few sentences of talking about the need to tighten your belt, like Alphabet did. Pure hubris. It was embarrassing and unbecoming. Hey, let me tell you something. You know what I said at the beginning of the show? It's not about friends. It's about money. Well, let me tell you something. I don't even want a friend out there after tonight. I don't care if they hate me. It makes me stronger. By the way, the idea that Google can spend money on anything and everything should be long dead. Plus, the endless junking up of search results to leading to search fatigue. I mean, do you ever try to use it anymore? Yes, we all need Google, but that no longer makes it a good stock. As far as management goes, I'll just say this. If Alphabet had gotten lean when the terrific Ruth Porat took over as CFO, they'd be in much better shape now. Instead, they've got a host of money-losing side businesses. I bet you a lot of the executives don't even know these businesses exist within their own companies. It's almost like it's beneath them. Oh, and let's make one thing perfectly clear. Meta, like AMD and NVIDIA, but those are two honorable companies, should have pre-announced the shortfall that I saw tonight. It was way too big to keep secret. No wonder the stock kept going down ahead of time. That's why the government has these damn rules. It's not cricket. It's not how you play the game. It's ill-advised, unfair, but they are unfazed, as has become typical with the firms out in Silicon Valley. They've made so much money. What do they care? They destroyed everyone. But what do they care? What do they care? Fifth, nobody enjoys firing people. I know I've had to fire some people in my lifetime. But when you lose your secular growth status like these companies have, you have to find ways to save money. And simply not filling positions is not enough. You need to do what's called layoffs, reductions in forces. No one wants to do them. But they don't even seem to know how to do them. I don't even know if they know it. I wonder if they think RIF is like some sort of thing like, I don't know, annual recurring revenue, RIF. Can they come up with something? Income in force? I don't know. Maybe I'll Google it. Oh, no, you can't. There's 70 things ahead of it. 6, we discovered last night that the data center has become a cost center. When I hear that the price of electricity in Europe is hurting data center profitability, I start thinking, what the heck? Are these chemical companies? If that's the case, I'd rather own Dow. It also makes me realize that the semiconductor industry, well, that may be an industry, with the exception of the honorable people at AMD and NVIDIA, well, maybe that's not even much of an industry. 7th, the FAANG cohort can no longer grow their way out of this jam by making acquisitions. You know why? Governments worldwide despise them. They hate them. Do you know that's the only thing that the Republicans and Democrats agree on? That how horrible these companies are? The Biden administration, in particular, would like nothing more than destroy these companies. Any excuse to go after them. But it's not just the Democrats. Hating big tech is one of the last bastions of... Hey, when you speak to guys like McCarthy, I speak to him, he's a minority leader, or you speak to the majority leader, they said, like, the only thing you can say to them when they're disagreeing with each other is, how about, what do you think of metaverse? Finally, tech companies issue stock endlessly and typically pay little to no dividends. Yet there are legions of stocks out there with immense buybacks and generous dividends, and many of them are much less hostage to the broader economy. It's time to recognize that FAANG names got too big. Can they turn things around? Sure, but they've really got to change the way they operate. Like we've seen Netflix rolling out ads to breathe new life to the business model. At least they're trying. I think Apple's trying. Now, some of these companies can be reset. Meta? I don't know. I think they have to change their name again. They really do. I mean, you can't be saying Meta. I don't know. How about Loser? How about Stuputa? I don't know. Anything. Anything. Doesn't even matter. I don't know if they can make a comeback. The facts have changed, and I have to change with it. I believed. I thought I'd be safe. I was wrong. Bottom line, forget being leaders. Big stocks are now followers in a post-COVID era, where we're learning that their earnings were far more inflated by the pandemic than we knew. We're just now discovering that the tech emperors have no clothes, if they're even emperors at all. Brandon in California. Brandon.
Big booyah to you, Jim.
Booyah.
My question to you, my good man, is I'm looking for a well-managed asset management company to add to my portfolio. What do you think about BlackRock?
BlackRock?
Yes, sir.
BlackRock is an excellent company run by honorable people who tell the truth as they see it and are very realistic, and I would definitely recommend that they are worth owning. All right, so look, am I hot under the collar? No, actually, I'm fine. I'll be more upset if the Phillies don't win the World Series or if the Eagles lose this weekend. But sometimes, you know, you got to blow off steam, particularly when you see trillionaires and billionaires unable to come to grips with the fact that they want to destroy everything you have. Oh, Mad Money tonight. Illinois Tourist reporter at top and bottom might be. You think they want to take everything you have? I think they just want to be good tool works people. Then earlier today, we got the largest IPO of the year, Mobileye. But could the Intel spinoff be investable after today's big run? I'll give you my take. And the financials are back in fashion on the Wall Street Fashion Show. So could Stiefel be a name you should keep on your radar? I'm talking to the CEO. Once again, you know what? No harm, no foul, Chief. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.